Okay, here we go. This thing aligned here. All right, well, thanks for coming to all the hype on a short holiday weekend. I'll try to make this as simple as possible as we talk a little bit about seller financing. We talk about buying down rates. I'm sure we're all familiar with it, but I thought it was appropriate to start talking about it now as we're looking at what the first quarter of next year is going to bring and what kind of the expectations we're seeing in both, in commercial real estate, we're expecting a huge drop in sales compared to what we saw in the first half of last year. This year, at the end, I'm not quite sure what the numbers are going to bang out to be, but we're expecting lower sales next year and just working harder for every dollar, which is no big deal for us hardworking folks. But we got to talk about what deals are going to look like. And I thought seller financing and buying down rates are some of the tools we can use to make these deals go. In fact, currently, we're doing some seller financing negotiations as we speak to close some of our deals right now. And I walked into a couple of meetings where people were talking about buying down rates for buyers on the seller side. So we'll talk about both and going forward. If you have any questions, there's just a couple of us on the call. Just pipe in and, it's kind of a conversation we're going to have. And let's see here. David, is this just you and I think. Oh, Courtney's here. Courtney's here too. Good.
Hi.
So more people hop on. If not, we can just Q&A and how we want to do it. So jump in or interrupt anytime. So let's talk about what we've seen, in commercial real estate, just in multifamily alone. In the first half of last year, we saw 373% growth in sales volume. There's billions of dollars being spent the last couple of years in investment real estate. And we know from the residential side, I don't have the numbers in front of me, but we know that those numbers have grown. And we know that probably May of this year is where we saw the peak of values in residential valuations and so forth. And we know since then things have changed as interest rates become higher and higher in the mortgage industry, as the inflation and what the federal government's trying to do to help us with that is affecting our purchase power for our clients. And it's just really important to kind of talk about it. I'm sure you guys have seen that in your own market, correct? Yeah.
Yes.
And so I really think that let's start talking a little bit about the seller financing pros and cons. Now, with seller financing, it's interesting because there's a couple different ways you can do it. It's an alternative way for buyers to buy their homes by going either for the seller to finance the second trust deed or just financing the first TD, depending on how you want to do it. Because of some of the lenders changing their requirements to weed out applicants with poor credit or with some other alternative lendings that is not available to people right now, seller financing is usually a cool way to figure out if you can do it. Now, the big issue is how much does someone actually owe on their home, right? Because if you owe too much on the house, you have to require that the buyer come in, put enough down to wipe off their debt so that the seller can finance whatever debt's remaining or what debt they need to finance the home. So it can be seller financing, and this process implies, that they're going to finance it, but can they or can't they? Are they only going to finance a second trust deed or a first? Depends on how much they own the home. And, we can figure that out with our clients. But how the financing works is basically, if you're eligible for a small mortgage loan, right, and you want to try seller financing, you can attempt to convince the owners to do it, but they have to be willing to do it. There are some pros and cons, obviously. If you go with seller financing, they'll require you to sign a promissory note that's written up in escrow, and escrow will do that for you and put all that language together on the terms of which both parties agree. as far as scheduled payments, interest rates, term, all the things that would normally go into a loan or a note of this size. Now, the benefits of this type of thing can be that maybe, just maybe, you can go with less than 20% down if the seller doesn't have a tremendous amount of debt already on the property. But that's just going to depend on case by case basis. But the benefits of for the buyer are the fact that there's a lot of requirements that are not going to be looked at as the way the bank would look at it. Now, the seller obviously is going to have some requirements and look at your credit and look at cash in the bank and your employment and so forth. But they're able to make a decision based upon their own gut level and their analysis, not from the bank. And that's usually why the buyers usually come to the seller for the financing, or even, let's say, for example, to finance a little bit of their down payment on a second trustee. If they need 20% down for the bank, maybe the sellers want to come in and say, hey, we'll finance the difference and give you a little bit of money to finance over maybe 15 years or whatever they want to do. Now, the benefits for the seller is they get a little bit more interest in the property off that coupon that they finance for you. And they also get some income stream, which is kind of cool. It's got its own tax ramifications, but if they can retain obviously some of the title or all the title of the home while that debt is being financed by them for a period of time that they need it. But this all comes about because interest rates are so high, right? So interest rates are so high, so people can't buy as much as they used to be able to purchase. Maybe they don't have as much down, because even though prices have come down, we're still seeing a need for more money, 20% down to make the payment right. So there's a lot of give and take in that scenario. Now, in commercial real estate, it's really different because the tightening of the credit markets has reduced a lot of what we call the non-QM, the non-qualified mortgage products, the ones that require just assets or bank statements, or what we used to call the no income, no asset loans, stated loans. Some of those have gone away. And some of the land deals that people are trying to finance only finance now to like 30% of the value of the home. So an LTV of 30%, or I should say the investment real estate. And so some of those were at 50 and 60% at one time, and now they're only 30%. So in the investment side, on the seller financing, to close a deal like what we have going on currently, let's say the seller, the buyer can no longer, the investor has nowhere to get financing for, let's say, a piece of land or a vacant multifamily building, which is a perfect example. Then they're going to require that the financing come from the seller, if not for a long period, but probably a short period of time, because no one will finance that particular type of asset. Land has really no income. It's just land, and you're going to be lending money to the investor, right? A vacant apartment building has no income. So right now, it's almost impossible to find someone to finance an apartment building with all vacancies. Even if you could get occupancy up in the first 6 months to 80% or 90%, you still can't get financing from traditional lenders right now in that space. So seller financing becomes a key issue. But it's kind of a negotiations, right? You need the money to close escrow because you're the investor. But the seller is saying, well, in order for me to give you that loan, I'm going to charge you this much interest for this period of time. And I don't want to have this finance for more than 3 to 5 years. So it's really a negotiation, but it's really necessary right now in commercial real estate to close some of these transactions because there's no financing available for some of these deals in which we'd like to close. And it hasn't been that way probably for more than 3 or 4 months, but things aren't getting any better, and banks are tightening their restrictions on lending, and the non-QM, the qualified mortgages, the non-QM loans are tightening and going away They did that at the beginning of COVID. I think I was at March, we began, I think, right? In March, COVID shutdown became, and by April 1st, all the non-QM mortgages were gone, like overnight. It took 30 days, but they were gone. You couldn't get a loan unless it was traditionally financed with a W-2 and income, and it was really difficult. So the seller financing is becoming more popular now. We're going to see it come about, and you're going to have to be able to negotiate. You're going to have to be able to say, hey, I want this for my buyer. How do I go about getting that done? And you're going to reach out to people that have done it before, people like myself or people in the office or your broker, and find out exactly what the benefits are for your buyers. But if you represent the sellers, obviously, there's benefits for them. There's also drawbacks. It can be very, very risky for the owners. If the buyer's defaults in the loan, I mean, you get the loan, you get it back, but you've got to foreclose. And there's fees and costs and everything as it relates to foreclosures and getting the land back. Getting the paperwork right on the coupon and the note and the promissory note is very important. So it's important that you're working with a really good escrow office that has an attorney that can look over that paperwork for you. There's everything that goes into it is really strategic. So it's very important as we continue down this road, as things starting to tighten, interest rates are going to get higher. We have to be prepared to ask for if the seller would finance a second trustee to help us work this out. For many of you who have not done this before, we used to buy homes with two loans. You had an 80% first trustee and you'd have a 10% second. And that would finance the loan. So you're still only coming with 10% down, but you would have a 10% second trustee as a financing tool for the loan itself, because lenders were not going to lend more than 80% of the appraised value of that home. So this gets real technical real quick. You can use lenders to help you understand it better, but as they become more and more strict about what they'll do and what they won't do, you may start seeing loan to values that are only 80%, maybe only 85%. So you really need to be careful when moving into this next group of, let's say, quarters, first quarter of 23, second quarter of 23, what lenders are doing, what products are offering. If you start to see products that your lender is offering that are lower in LTV, you have to start thinking about seller financing or where you're going to get your second TD for your buyer. That's pretty, the seller financing. Does anyone have any questions about seller financing? Has anyone ever done seller financing?
Yeah, Jason, I was about to do a seller financing on one of my properties, but I decided not to because they were coming up with a lot less than down payment that I was expecting. Because with those type of, can you hear me well?
Yeah.
Yeah. Because I thought to myself, the margin of error is, or margin of safety is not really that much. If some people, they just want to take a chance on, 10%, 20%. And if it doesn't work out, then they can just let it go. And, as a seller, we got to be very careful because there are people out there that they come in and they want to just take a chance on a property. And if it works out 10%, 20%, fine. If not, then they just let it go. What do you know about that? Is that something that the seller should be concerned about?
So what you're saying is the concern for the seller is that people that want seller financing want to come in and say, hey, I only want to put 5% down or 10% down. Will you carry the first at 90% loan to value?
Right.
Yeah, it's a huge risk. I mean, that's why the banks start to tighten things up, right? So they start to say, you know what, the risk is too high. Future values are coming down, so I'm only going to offer 80% of the current value. So what the seller ends up financing is really dependent upon what it is they're financing. If they're financing a first trustee, sometimes those sellers won't do more than 70%. It still requires that the buyer put some skin in the game, right? And you have to also wonder why is it that the buyer can't get the loan? Right? Like if it's the asset, like in commercial real estate, if it's the asset that's precluding the sale because financing isn't available and something like that, that's a different discussion, right? That's a land asset that no longer has financing available for it because of the market.
Mhm.
So seller financing makes sense because that market will come back. There's ability for more cash to come later. So that's a little bit different situation than, let's say, a single family home or a duplex, or where someone's going to own or occupy it, right? The financing exists, but it only exists at this level: 80% loan to value, 760 credit score. You kind of go down the road: owner occupied, no late payments on mortgages. So you got to find out, why is it they can't finance it? If it's the asset that's precluding them from selling, then the seller should step up and be able to offer some financing. If it's the buyer who can't qualify, that's a different story. Right? Does that make sense?
Yes, it does. Yes, it does.
Yeah.
Thank you
So
for
you
that.
get two different scenarios. And the other thing too is, let's say, for example, they've got let's say the loan to values on the loan for the first trustees 80%, and the buyer only has 10% down. So they want the seller to take a 10% second to help them, right? Well, one, does the bank that holds the first, will they allow a second? That's one thing you have to find out. Two, if they don't have enough money to put down, why is it they don't have? What's going on that's keeping them from, borrowing money from a relative, or, getting money from mom and dad, or doing something? What is it that's going on? And we're not in that market yet where there are not enough buyers. When that changes, right? When there's not enough buyers for the volume that hits the market, whenever that may come, that's when sellers start having that discussion. For right now, if you can't afford the down payment, even if I'm going to finance it in the residential world, I'd probably find another buyer, because there's a ton of them out there, right? But in commercial real estate, it's a little bit different. There's not always a buyer for that particular asset, and what people are willing to do to close the deal and make it happen. But it is available on both sides, and it can work. It's complicated, and if you've never done it, then you need to get help from somebody who has, and work with your broker, or someone who's done it before.
I was in a meeting last week and someone brought up this, have you ever heard of novation agreement?
What's it called?
Novation.
Novation?
Yeah.
Nope.
It says something about is similar to assigning the loan, but once you assign it, then the assignor has no more responsibility. And it says for some kind of a fee or 1% or something, insurance companies insure that. I don't know. I haven't done that before. I haven't heard of that. That was the first time hearing about it. And they said that it's coming up now these days because people can really get financing, and they do sign an novation agreement with the seller.
No, nothing about that. You find out more about it, send me as much information as you can.
Okay.
I know that, let's say, for example, if the seller provides the financing,
Mhm.
they can sell that note to someone else, right?
Yeah, that's assignment, isn't it?
No, selling the note and assigning the note, two different things.
Okay.
Because you're not assigning it to one person or another. You're actually selling it to somebody.
Mhm.
The novation thing, I'm not familiar with.
Okay.
Nope, not at all. There's always something, right? There's always some weird thing that goes on, and I get real nervous too, because when we used to do financing way back in the day, there was some creative stuff coming down the pipe, and we used to just pull up our fingers and do this. No thanks. So yeah, if you hear more about it, let me know.
Okay, okay, I'll do that.
Now, what about let's move on to buying down rates. You guys coming into that yet?
No, not me.
So buying down the rates is really expensive. But if the seller has enough equity and they want this buyer to have the house, they can actually purchase the rate down for the buyer through their seller funds. But some of these buy downs are $9,000, $12,000, $13,000. And the reason people do it is because the buyers are asking the sellers to do it for them. Now, what's interesting though, is because there are still people out there buying homes, and not as many, but there's still more than one buyer for every house. If I was a buyer, if I was a seller, I don't know if I'd pick the guy who wanted me to buy down his rate. Although if his package was strong and they could close, but what they were looking for was below 8%, and they were going to buy it down on a 30-year fix to make the payment work, and they has enough cash down and they were strong versus everybody else that sent in an offer, I might do it. But there are times when your buyers are going to need to qualify at a lower rate, and the seller is going to have to help. It's like getting closing costs from your seller, right? A little help so you don't have to come up with the extra, 2 or 3% to close the deal. And most lenders allow it. Now, I don't know what today's rates are. I didn't look today for residential rates, but I'm thinking they're like 7.5%, 7.75%. And we start getting into.
No, actually, it went down last week to 6.7, I guess. It went
No,
down.
it did.
Oh, yeah, last week. It was one of the biggest moves ever, but I don't know if that's gonna be kept that way or it's gonna increase again. Nobody knows, I guess.
Yeah, because like a week before, I was like up almost a point from that.
Yeah.
So let's just say, for example, things start to move up and your average rate's like 7 7/8. So you're getting to 8%. Well, if I could have a rate at 7.5, save a couple $100, maybe a 7%, and save a couple $100 on my payment over 30 years, I'd want to do that. And if I don't have the money to do it, I'm going to ask the seller to do it. And the seller can, but there's limits. There's limits on how much they can spend on credits, buy downs. There's also limits if you go back to the seller financing. Since the banking laws changed, there's certain limitations on seller financing as well. So how much seller financing are you doing on a regular basis? There's a kind of a calculation and limits to all that kind of stuff that probably doesn't apply to most people, but there are limitations. And there are limitations in the buy down on those rates. But I think people should start. The reason I brought this up today was because I think people should start getting ready for how this is going to look. How are we going to start negotiating deals when it doesn't work for my client? When I get to the end of a transaction and all of a sudden, I can't close because there's no financing available for this asset. I've got to lean on the seller to help me finance it for a short period of time until I can collect enough money to pay them off or get financing, hopefully in a market that's changing. I think for everybody, my best look at what I've seen and all the stuff I've read, the next 2 to 5 years is going to kind of be rocky, depending on how hard you work and what deals you got. And you've got to be flexible. You've got to be able to understand what you're looking at when you're looking at an opportunity, because you got to be able to offer solutions that weren't available to you, 6 months ago or 3 years ago for the past 5 years. You've got to be able to get in there and say, okay, there's a couple different solutions here. Because I know, for example, that, from an investment real estate perspective, that my investor wants to buy something new and roll their equity into something else. Or my client, my seller wants to move to wherever they're moving to retire, and they've got to move. And I know that they don't want to hold back, and not selling isn't an option. So you have to offer some options to get things done, especially with seller buyers that come in. If you got a purchase requirement for a client, you got to find a way to get it done. And it's really important that you have those discussions and how they work with your mentor, your coach, your broker, whomever that's done it before, that you can rely on and trust, so that you can get these deals done, because they're not going to close themselves. The lender's just going to come to you and say, I'm sorry, we're at 80% loan to value, and the value is this. That's all we can offer you. And when the non-qualified mortgages aren't available, especially in residential, they dry up fairly quickly. It becomes an issue. I mean, I don't know. Have you ever used recently, in the last couple of years, any stated loan products on your purchases, David?
No. The commercial is different because most of the commercial is based on the income of the asset, not based on the
Correct.
income of of the buyer. So that's kind of different, but it depends. I've dealt with SBAs a couple of times, and they're much. It takes longer, but it's easier to do if you have time, because it's more streamlined, but it just takes longer. But overall, I think seller financing, it's one of the pros of seller financing for the seller is that they don't get taxed on the whole thing the first year. So they get taxed on what they get in that year. So that's a pro. If somebody doesn't want to pay the whole thing at once, they can just do a seller financing, and they can pay taxes as they get the payments.
Correct.
A lot of older mom and pop people, they like that, because they're looking to retirement, and they can't do anything with everything that they get. They just want to get a portion that they can live on for a while, and then get yearly income on that. So that's a pro for the seller financing.
Yeah, and it's additional source of income, and it's essentially the same thing as investing in a real estate property. It's just a little more personal, right? Because this is your house. Now, one of the nags of doing the seller financing too is, in the event, let's say, let's take the pro, but back up. So take the pro, say, hey, you know what? I'm gonna do the seller financing, and therefore I don't have to do any repairs to close this deal, right? I'm gonna go ahead, I'm gonna finance it, I'm gonna be the bank, and I don't have any repairs, and that's really good for me, no cash out of pocket, blah, 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 blah. The flip side of that, the negative, is in the event that they default, the buyers, and you have to take the home back, before you put it back on the market, you'll have to do those repairs or more, depending on the condition of the home after they leave or are evicted. So there's a risk involved. There's always a risk, right? But this is the risk that's involved in the seller financing, which is a huge, I don't know, it's a huge ask in this market, but eventually at some point there will be some people doing that. I mean, as things change, and we don't know exactly how things are going to change. I mean, I kind of go with the 15% reduction in values and a point higher than 6% on the mortgages over the next year and a half. Like I just think rates are going to be in the 7s, and I think values are going to come down 10 to 15%. And
so what you said right now goes back to the margin of safety. So if you are really getting good down payment, and if whatever they don't repair, they don't do, you can actually go back and use those funds in order to get it repaired and put it on the market again. So my point is that I think in seller financing, there should be enough skin in the game for the buyer to making sure that they're doing their own due diligence, and they're doing the right thing for the property, not just coming in and try to guess if it's gonna work out for them or not, and just take a chance on it. So you want to make sure that your buyer that is coming in, uh, again, having a good skin in the game, not coming and going, not even thinking twice about going into foreclosure.
Sure, no, I totally agree with you. If you're the seller and you're assigned to finance, the down payment better be substantial,
Right.
right? No, absolutely. And the interest rate, I mean, if you're taking a risk, you know, you don't have to charge what banks charge if someone's coming to you for some other reason. You can get a little bit higher interest rate for the risk you're taking as well. So your monthly income is a little higher than it normally would be,
Mhm.
especially with inflation, the return, you know, it's got to meet up those requirements as well. Yeah, that's good stuff. They're really good stuff. I
Right.
think as we start to see volume slide in sales, I don't know what the numbers look like today, but you know, there's going to be a reason for people to make different decisions coming up fairly soon. And I think we all have to start thinking about how that's all going to kind of trickle down into our business and also negotiating this because, you know, it may seem like a clear and simple answer to us, right? We're in the business. It's a clear and simple deal. This is how this looks. You know, taking David's example. Hey, look, they're putting 40% down. You're getting 8% interest. It's a note that's for call it 7 years. It's amortized over 30, but due in 7 and fixed for 7 years. This is a no-brainer, Mr. and Mrs. Seller. Um, you should jump at a chance at this, right? But it's not quite that simple. People see their assets, homes or investments differently, and they're connected to those for a certain reason. So you have to be able to understand again where your client's coming from. Otherwise, you won't be able to suggest a solution that they would feel comfortable in making. Does that make sense?
Sure.
Because otherwise they're like, well, no, it doesn't sound good to me. I know I don't want to do that, or we'll just take it off the market, or we'll sell to somebody else. Well, what if there isn't anybody else? Right? You have to be educating your clients. Like, well, you know, you own a 2-bedroom home in a 3-bedroom neighborhood, you know, 3 to 4-bedroom neighborhood. There aren't going to be a lot of people buying your house right now. We had that happen with my grandmother's house a couple months ago. You know, I mean, the appraised value came in on a refinance at 900,000 and it sold below 8 because that's what it was worth to the marketplace. It was in a 2-bedroom deal. So you have to be able to explain that to people why to take advantage of the opportunity in seller financing or rate buy down. And the rate buy down is probably going to be more, I would say, more popular, or you're going to see more of it coming soon because people are going to want a lesser of a payment. I mean, what is it now? $700 per $100,000 finance right now, something like that. PITI, give or take. It's really expensive right now. $1 million home costs you a $1 million mortgage that costs you $7,000 a month. That's a lot of money. A lot of money.
I got a question for you, Jason. Besides looking at real estate indicators, what other key indicators do you look at to see how the economy is and what the next 6 months is going to do? Is there anything else that we should be looking at?
Well, the indicators that we utilize a lot of is just trending. So we look at where we were 30 days ago, 60 and 90 days ago. And we look on the sales volume, and then we look at financing, and we look at what's going up, what's going down in the trend. And when we start to see that there's less volume being sold, less deals being closed, we wonder why. So we have to look at financing, we have to look at things change in that realm, we have to look at the volume of, even the number of loans closed in different asset classes for us. But you have to look at and see what the trend is pointing towards, right? You can always have a spike up or down, but what's the trend, right? I mean, I read a report the other day that had to do with the 30-year residential asset performance of appreciation. And it's called the, can't remember the exact word for it, but the trend line, right, it's always been like 3 to 4%. The 30-year return on appreciation, whenever they started measuring it, it's kind of a moving forward number, right? It's just kind of moves 30 years. And it's always 3 to 4%. No matter what's happened in the industry over 30 years, it's usually 3 to 4%. Well, in order for that 3 to 4% to happen in the 30-year time period, there's only there's like 4 years left, 3 years left in order for that amount of appreciation to work. Otherwise, the appreciation is going to be way larger than the 3 to 4%. But we know that the 30-year look is always the more accurate look. It has been forever. So in order for that to happen, prices would have to drop from the May of 2022 top somewhere between 30 and 40% from their highest level. And that's a hard one to swallow because there's no outlying reason currently for the market to totally collapse like that. The last time it was about financing the stock market, collateralized debt obligations, and investment products that were bogus. Right now, lending's strong, underwriting guidelines are strong, buyers are strong. We've got FHA loans that are kind of used to be the really the new subprime, but not a lot of those as much as as many. So what's the underlying factor there? There's still a lot of buyers, and there's still too few homes. So what's the underlying factor would cause that to happen? I'm not a big believer in that. I think it's more of a 15% correction, but we're seeing it now, and we're seeing people make different decisions. The other kicker is how much money is out there right now. I think there's a lot of cash out there. I think the deposits are up. I think people are hoarding money. I think there are large institutional investors that have set aside billions of dollars waiting for a market to take a correction so they can clean up and buy things at a discount. But because there's a lot of cash, we see a lot of deposits. We see a lot of institutional money that's being deposited and money that's being raised. I have a group out of Long Beach here that raised for a syndicated fund for Arizona, and they were looking for 25 million bucks, and it took them no less than 4 months to raise 25 million for investment into a syndicated multifamily investment group. $25 million in a short period of time, and they got that done between June and now. It's not even the best part of the year. So I think we look at those things and we say there's still a lot of money on the side. We still think that the trend is going to be down, but we don't know how far down. And we know that the lending's tightening up. When the lending tightens up, transactions stop. And we have to be careful not to overlook what the banks are doing. Talk to your lender, talk to them about how many mortgages they've closed versus what they closed last quarter. Keep track of those, but trending information gives us an idea of where we're headed. That's the best we can do.
I don't know if you saw or not, just today, there was an article from CoStar that Los Angeles apartment rents are declining. How is that going to affect the investors that they're trying to get in, but the price is still high, interest rates are high, and the rents are declining? Doesn't that put pressure on the prices eventually?
Yeah, of course. Anytime that you decrease the net operating income of any asset, the price is affected because the rate of return is lowered.
Mm-hmm.
The kicker is, this is the kicker. the kicker is how low of a return are people willing to go to grab an asset? And that's what the sellers are pushing right now. So a lot of my clients that have properties still think that their assets are worth what they were worth 6 months ago. And they're not, because investors aren't willing to spend more than X number of dollars, and as low as they'll go is probably a 4 to 4.5 rate of return, a capitalization rate of 4 or 4.5. Because there was a time when this wasn't happening and people were taking to market at below 3% rate of return just because they could get it. So that gap now between what the investor with the sale requirement and the investor with the purchase requirement is still pretty big, but it's got to get a little bit smaller for everyone to do business together.
Mhm. And how do you see the relation between the 10-year treasury right now? Because the 3 months yield on the 10-year treasury is now inverted. Now it's really much higher than 10-year itself. Is that gonna be?
I don't think I'm not. I used to look at those a lot in the inverted yield curve, but I think these days all that stuff's out the window. You can't make sense of it anymore.
I mean, why do you think is not relevant right now? I mean, what?
It's
what has
harder.
changed?
It's hard. You used to be able to take an inverted yield curve and predict what was going to happen next, right? I mean,
Right.
those two things can't stay inverted too long, or bad things happen.
Mhm.
But when or what and how bad is harder to predict these days, and it's not as black and white as it used to be. I mean, I know my econ professors in college are probably just going nuts, telling me I'm, no, go back to the basics. But in the 2000s, I forget when, early 2000s, there was an inverted yield curves for a while, and they were trying to, it was Habib, I think, was trying to predict, and it's just, it became almost ridiculous to try to predict where that might happen and how bad it might get. Especially with the way that our monetary policy right now is trying to catch up with inflationary pressure. We're not quite sure what that's going to do to everything and how far they'll go. But it's really hard to say. Does anyone else have any questions? Courtney?
That was really good. No, I don't have any questions.
Okay. Courtney, have you had any people come to you for buying down rates or seller financing?
I've had just issues, period, with financing so far. I just wanted to know other options, if there's other options out there. I just got my license, so I'm just trying to weigh my options, obviously.
Yeah. Well, make sure you're talking to the local mortgage rep in your office. Ask them what's going on. You can get a feel from them. The government financing continues to kind of blaze a trail for a lot of investment properties between 2 and 4 units with FHA, especially owner occupied. They're going to continue to be like the great advocate for transactional sales, because they're going to still offer financing with little down if you're going to owner occupy it. So look into FHA for 2 to 4 units. And then of course the VA loans are fantastic. Those continue to help out veterans, more than we possibly could ask for as far as financing is concerned. So look into that as well.
Okay.
So the question here is, when you get into it, when you get into a transaction and you represent the seller, you represent your client who's selling the property. When someone comes to you with seller financing, what are the parameters in which you recommend doing it or not doing it? You have to make sure that you talk to your broker, that you talk to the lender in the office to make sure there isn't a product for someone like that, because you have to be careful of all the above, right? Everything from credit reports, fraudulent this, fraudulent that. It's a huge risk for people to take. So you have to be good at what you do, and you have to ask for help, because you're putting your recommendation to your sellers about doing it. It can be a big risk, no matter what the pros are, and no matter how well the transaction's done, the language of the coupon, and everything that's done right, it still can be a huge risk. So make sure you consult, make sure you have a hold harmless letter signed. There's a lot of good stuff there, but make sure you're asking for help. Don't try to tackle this on your own. If you've never done it or know where to get help, make sure you ask at least your team leader, or someone running the office to start there, where to go get help on that stuff. Very, very important.
Thank you.
Yep. Any other questions or concerns? No. All right. Well, it's let's see, 1:49. I'm all done with my content. If anyone has any questions or concerns, that's it. Everyone have a great Thanksgiving holiday, and then we'll see you again next month.
Thank you, Jason. Appreciate it.
Yep. Thank you.
Thank you.